The Intelligent Investor Summary and Key Points. In today's video, we're going to summarize and look at the key points from the book The Intelligent Investor by Benjamin Graham. The Intelligent Investor is a book which aims to help people with investing in the stock market and aims to minimize their risks while doing so and teach you to become an intelligent investor. The book focuses on low-risk strategies and long-term strategies for investing. The approach is focused on investments which are based on research rather than investments which try to speculate the market through predictions and hearsay. The Intelligent Investor provides sound guidance on how to use value investing in the markets and how to reduce your risk when investing as much as you possibly can. Successful investing is based on a sound intellectual framework for making decisions. You do not need a brain like Einstein to find great opportunities for investment in the stock market, although this is what the Wall Street crowd wants you to believe. A sound understanding of the stock market and some basic rules for investing will see you having similar results to some of the top investors in the market today. Once you know what to look for, you can make decisions armed with the same information as the big Wall Street firms. If you are interested in purchasing the book and reading it for yourself in its entirety, there is a link in the description below. Before we get into the summary and key points of The Intelligent Investor, please hit that subscribe button and comment "I subscribed" below so I know who is serious about their financial future. Once subscribed, you'll be a part of this amazing community who are all working together to achieve their financial goals. Subscribed? Okay, great. Thanks. So, who is Benjamin Graham? Benjamin Graham is a British-born American economist, professor, and investor. He is known as the father of value investing. He was born in London, England in 1894 and died in 1976, aged 82. His work in investing has led to a modern wave of value investing within mutual funds, hedge funds, diversified holding companies, and other investment vehicles. Throughout his career, Benjamin Graham had many notable disciples who went on to receive massive success in the world of investment. These people include Irving Kahn and Warren Buffett. Buffett went on to describe Graham as the second most influential person in his life after his own father. Warren Buffett has referred to this book as by far the best book on investing ever written. So let's summarize some key points and takeaways from this amazing book. Graham says in his book that to be a successful investor, you need to be patient, disciplined, and keen to learn new skills. You must be able to control emotion and think for yourself. When investing in the stock market, it's important that you keep a logical approach and that you always keep emotions out of the decisions you make. Fluctuations in the stock market are largely caused by human emotions. If the stock market was controlled by real logic and analysis, then you wouldn't see such wild movements. This book looks at highlighting the difference between investors and speculators who buy based on emotion rather than research. According to the book, intelligent investing consists of three things. 1. A thorough analysis of company fundamentals. 2. Protection against severe losses. 3. Realistic expectations. In the book, Graham points out that for an intelligent investor, gains are not made investing because the price of a stock seems to be going higher and higher. He proclaims the opposite is actually true. Graham explains that the more the price of the stock goes up, the riskier the stock becomes, and the lower the stock price goes, the less risky the stock actually is. Throughout the book, Graham has a character which he calls Mr. Market. Mr. Market represents the actual stock market, but is portrayed as an actual person for the purposes of the book. He uses this character to explain market speculation and how the opinion of investors can impact the price of a stock without any real logic behind it. Imagine that you had shares in the XYZ Building Corporation and you paid $5,000 for these shares. Every day, Mr. Market comes to you and offers an opinion on what he feels that your shares are worth. He offers to buy or sell your shares based on his opinion that day. During the life of the stock market, history has shown that Mr. Market's opinion about what a company or share is worth is pure speculation. One day he comes to you and says that the shares are now worth $7,000. Then another day he comes to you and says your shares are worth $2,000, even though the profit of the company has increased by 20%. Should Mr. Market decide how much your initial $5,000 investment in that company is worth from one day to the next? Well, no, this would be crazy. But this is what investors are basically doing every time they invest. They're letting people tell them what the company's stock is worth based on an opinion and current market price rather than sound fundamentals. One of the main principles in this book is that a stock is not just a ticker symbol and a price. It's an ownership interest in a business. Because Mr. Market isn't always rational depending on how he is feeling from day to the next, the value of the stock he is looking to buy on a given day can fluctuate wildly from one day to the next. But that said, if Mr. Market presents you with prices which are higher than you feel a company is worth, then you are not forced to buy from him. And if he presents a stock which you consider is a bargain, then you should be happy to buy from him. The advice in the book is to only invest if you would be happy to hold the stock for the long term without looking at any charts after you have bought the stock. When this book was written, people were only picking up one newspaper a day in order to base their buying decisions on, so Mr. Market was only visiting them once a day. Now people are bombarded with news and alerts to buy or sell 24/7, and Mr. Market visits them every minute of every day with notifications on their mobile devices. So just because Mr. Market visits you 1,000 times a day, it doesn't mean you have to trade with him 1,000 times a day. Only trade with him when he presents you with an offer which is right for you and meets your investment criteria. According to the book, there are two types of investors: the active or enterprising investor and the passive or defensive investor. In the book, Graham advocates the need to be a defensive investor. This is someone who takes a low-risk, long-term approach to investing. The defensive investor should create a portfolio with a mixture of bonds or index funds and the rest of individual stocks, with say 50% stocks and 50% bonds as a split. The book recommends that you invest a fixed amount of money at regular intervals in bonds, like monthly straight from your paycheck. This is referred to as dollar cost averaging, which most people will be aware of. You make regular investments of the same amount, purchasing stocks no matter the price. Some days you buy more stocks, some days you buy less, averaging out the peaks and troughs and the market fluctuations. When you're looking at buying the stock side of your portfolio, you should apply the following 8 rules. 1. Diversify the stocks you are buying. 10 to 30 companies will suffice. 2. The companies you invest in should be large, identified as over $100 million in annual sales, which in today's value would be approximately $520 million. 3. The companies you invest in are conservatively financed. This is defined as having a ratio of 200%, which means that its current assets are at least twice as big as its current liabilities. 4. The companies should be dividend-paying companies. Ensure they have not missed a dividend payout in the last 20 years. 5. The company should have no earnings deficit in the last 10 years. 6. The company should have at least 33% growth earnings during the last 10 years. 7. The company should have cheap assets. The price of the stock should not be higher than 1.5 times its net asset value. 8. Don't overpay for earnings either. Ensure the PE ratio is no higher than 15 when using the last 12 months' earnings. If as an investor you are happy to invest with modest returns of 9 to 10% annually, then you can apply all of these rules and you will not go too far wrong. But if you're looking for more gains in your investing, then this book looks at how to be an enterprising investor, which we'll go into next. Before we do, if you're still watching this video, congratulations. You are one of the few who really dedicates the time to improve your financial education. If you want to learn more about finance and investing and becoming financially free, then please hit the like button and subscribe. It really helps me to bring you more great content. And don't forget to follow us on Twitter too. There's a link in the description below. Thanks. To be an enterprising investor and to consistently beat the markets is much more demanding than it seems. In order for you to succeed as an enterprising investor, you need patience, discipline, a will to learn, and a great deal of time. For those bold enough to take the challenge, there are 6 rules to follow, the same as with the defensive investor strategy, and those are: 1. The company assets should be at least 1.5 times current liabilities. 2. Debt must be less than 110% of working capital. 3. Earnings per share should be greater than 5 years ago. 4. The company must be paying a current dividend, no matter how much that is. 5. The company's price-to-book ratio should be less than 1.2. 6. The PE ratio must be less than 10. The next key takeaway from The Intelligent Investor is margin of safety. The book advocates for an investing approach which provides a margin of safety for the investor. There are a few ways to do this, but buying undervalued, out-of-favor stocks is the most important for this. The irrationality of investors, the inability to predict the future, and the fluctuations of the stock market can provide this margin of safety for investors. Investors can also achieve a margin of safety by diversifying their portfolios and purchasing stocks and companies with low debt-to-equity ratios and high dividend yields. The margin of safety is put in place to mitigate the investor's losses in the event that a company goes into liquidation or the shares plummet sharply. The book reveals a formula which can be applied to a stock price to ensure that you can build in a margin of safety. Typically, Graham purchased stocks which were trading at 2/3 of their net value, which builds in a margin of safety of 1/3 of the value. Net value is another technique developed in the book by Graham as a value investing technique. This is where the company is valued only on its net current assets and intrinsic value. The formula in the book for finding the intrinsic value of a stock is V equals EPS multiplied by, open bracket, 8.5 plus 2G, close bracket, where EPS is the company's previous 12-month earnings per share and G is the reasonably expected 7 to 20-year growth. The V in the formula represents the intrinsic value of the stock. Graham later revised this formula based on the belief that the greatest contributing factor to stock values and prices over the last decade has been interest rates. In 1974, he rewrote the formula as follows: V equals EPS multiplied by, open bracket, 8.5 plus 2G, close bracket, multiplied by 44, all divided by Y, where the new value Y is the current yield on AAA corporate bonds. See beyond the horizon. In the short term, the market is a voting machine. In the long term, it is a weighing machine. There are always people telling you when the right or wrong time is to invest, but the truth is, over the short term, there is no way of knowing what the markets will do. Over the long term, though, the markets will reflect the true intrinsic value of the stock. You need to find the stocks which will be in huge demand over the long term, buy them, and hold them for the long term. Think in blocks of 10 years for holding rather than months at a time. Remember, as always, it's time in the markets rather than timing the markets. If you would like to read the book for yourself, there's a link in the description below for you to obtain the book. Watch this video next to continue your financial education, and I'll see you in the next one. Don't forget to like, share, and subscribe. And share this video with your friends. Thanks for watching.